So you want to know, is what you're hearing in the news accurate to what is actually happening in real estate right now? Well, on this week's weekly market update, not only will it bring you a couple extra factors that are impacting the real estate market, but we'll cover overall what the interest rates are doing and what we need to look for every single week so you better understand the impact it's most likely having as what we would consider the new threshold for affordability. Now, not only that, but we'll cover the impact that inventory is having at the current moment. And for many people who are thinking about being in the market, you'll want to continue to follow what's happening nationally so you make good decisions locally. And on this week's segment, as always, we'll bring you that impact that the nation is seeing to how it's impacting you here locally in Colorado. Thanks for sticking around. Let's dive right in to what we were talking about, which is what is the new threshold for affordability? As you can see in this 30-year fixed mortgage interest rate graph since January of 2012, we saw a peak in 2018 of about 4.9%, which brought a lot of people out of the market. And we saw a little bit of a slowdown. However, the slowdown was not in pricing. It was just in the amount of people entering the transactional amount of real estate transactions occurring, meaning how many people were entering demand the market. As you start looking at what happened in September of last year, the bottom, as you can see from January of 2021 with interest rates, we saw an entire year of momentum leading into the beginning of 2022. And the second that interest rates started rising, we saw a lot of people exit the real estate market based off psychologically the thoughts of affordability, as well as for some, the actual affordability of what they were looking for. And as those numbers increased over 6%, what we also saw was that as soon as about 5% came about with interest rates throughout the year, that this was the new threshold for affordability, meaning more people came to the market as soon as the interest rates dipped back down to the mid fives. So then what you saw is that we saw interest rates towards the end of the year and the beginning of the year go all the way upwards over to 7% and then come back down again. And as we saw them hover around the 6.5% to all the way down below 6% a couple weeks ago, we saw an increase of demand, mortgage application, and people getting back into the market. So the question is, what's the new threshold for affordability as this becomes the new norm? You're starting to see that most people are thinking it's probably around 6.5% or maybe 6%. But the challenge is what happens with interest rates. And over the last couple weeks, while we saw a robust retail report, unemployment at very minimal levels, we saw inflation down, but not the rate that many people would like to see it, is as these economic factors show strength in a robust economy, we start to see interest rates rise again like they did last week. And the question, which nobody can answer at the moment, we'll have to follow this week by week by week, is, well, what does that do to you, the consumer, and the psychology of affordability based off now where rates remain? If they go back up to 6.5, 6.7, does that take people out of the market? Or do we say, nope, that's the new threshold for affordability? And the reason being is that we know that as soon as they go sub 6, many people flood back into the market. So we'll continue to follow this over the next couple weeks. Thank you for keeping current in what's happened in the market, because this information will become more relevant to you as you've been watching it for a longer period of time. But what is happening with the inventory levels, because those will most likely dictate pricing, which we'll show here in a couple slides. You can see that inventory continued to drop another 3% this week. Remember, seasonality, it's normal for some more buyers to come out. And we're not seeing a dramatic increase in buyers, but we are seeing a lot more demand that it's taking inventory off the market. And as we don't have new inventory being released, which I'll show in the next slide, is the inventory is dropping, which is not normal for this period of the year. Usually in February, March, we start to see increasing inventory because a lot more people are bringing their homes to the market and the demand doesn't keep up with the spring selling season. So the challenge, as you can see from this graph here, is that we have 13% fewer listings than we did this time last year. Remember, the red bar graph is the new listings. The light bar graph is the new listings with immediate sales. So for many people, what we're running into is the challenge of not having new listings come to the market. And if new listings do not come to the market and the demand is still there, the inventory continues to do one thing, and that is drop, which is what it continued to do through the years of the pandemic, meaning not pre-pandemic did we see those numbers. So for many people, you can see right here, the active inventory and projected 2023 single family numbers is at the beginning of the year, our estimates were that we would probably see somewhere around 700 to 800,000 homes at the end of the year. And remember, the normal, if you take previous years, looking at 2020, 2019, 2018, 2017, is these numbers, as we continue to see them impact us within the inventory levels, is based off of sub-normalized numbers. We really are accustomed to seeing about 800,000 homes available on the market. So as you continue to hear headlines, just remember the numbers that we really want to start seeing is the available active inventory, much greater than where it's at right now, which, as you can see, what graphs are those similar to is the 2022 and 2021 number. So the 500,000 to sub 500,000, which is where we're headed right now, you could see that that bar graph, the strong red line, is actually continued decrease, with our expectations is that it would start increasing again. But the challenge is week by week, we'll follow that as we measure demand for home buyers and new threshold for affordability, as well as overall, are we getting new listings? Now, the median home list prices, as you can see, are continuing to go up. But if you really look at the prior to, let's just call these peaks and valleys, you could see that those were dramatically increasing at a higher rate. So this looks a little bit more normalized to the prior years, which goes back to a lot of the experts' predictions that home prices will remain flat or see a little bit of appreciation. But we must take into context that the normal appreciation rate for the last 30 years prior to this pandemic home price appreciation problem was around 3%. So flat to 3% is a good number when you're looking at historical data. And obviously here locally in Colorado, that historical data over the last 30 years was 6%. So again, double what the typical national number is. And a lot of times you'll find that is similar with inventory and the type of market that we are in here locally. So as you can see here, the pending homes with the contract is down 23% than last year. Now, however, as you can see this kind of like apocalyptic bottom, we are rising out of it quite fast. Remember, this correction that happened come June, July of last year, where just many people exited because of, again, having the psychological, financial, and all the impacts of seeing rates go from sub threes all the way up to 7% was just something that had never been done before. And you'd have to expect that some people might just say, time out, let's wait, see what happens. And now you're starting to see that bottom. We're getting back to a lot more people transacting or pending homes, meaning the demand is back in the market. Now, as you start looking at this graph here, though, a couple slides that I'll close with today that's interesting is the median price of homes in contract. You can see that homes in contract priced the same as last year at $368,800. So we're not continuing to see this rise of home values year over year. So this is again another sign from 2022 to 2023, the average home price being listed or the median price of homes in contract is roughly about the same as where it was last year, meaning that we're not going to see this dramatic rise in prices. However, that might change if we continue to see a dramatic decrease in inventory and a rise in demand. Now, as you start looking at some of the other indicators of the market being healthy, is we look at the fewer price reductions that are happening each week. You can see that about 32% of properties are receiving a price reduction, which if you take into account the numbers in June, July, August, September, October, November, December, that's actually more of a normalized market when you look at the numbers from 2019, 18, and 17. So again, right at about 30% is a healthy number of homes that need a price adjustment just due to the fact of the normal market tendencies and or psychologies of people as they're out there looking at homes that have stayed on the market for a longer duration or period period of time. And a lot of those things, as you continue to see where these numbers take us, is we're going to have to figure out what exactly is happening with demand, with rates, and then inventory. If more people don't come to the market and those rates do create a new threshold for affordability and that demand remains exactly where it is, we'll probably continue to see inventory decline, which will create upward pressure on home prices. But the overall goal right now is to get to a more normalized market, yet we need a lot more inventory. We need a lot more available active inventory sitting on the market. And sometimes when we're coming from so much of what we've had for a period of time, it's going to take some time for people to get used to what it is today. So make sure you continue to connect with your local market experts who have this data, who can articulate in a way that's meaningful, not just on what's happened in the nation, but then how does that relate to you locally? And then especially, remember, we have a lot of micro markets where there are certain neighborhoods and areas that are doing much better than others based off this available or lack of available inventory and overall demand when you look at where people are wanting to be in different states, cities, and areas across the nation. But from me to you, as always, on this week, I hope that you're staying current to what is happening in the market. You are dreaming of where you want to see yourself in the future, and each day preparing and taking steps to work towards that. And if you need help, always schedule a strategy call with us, as well as across the nation. I can put you in contact with the top 1% of agents all across the world to help advise you on the steps that you can be taking to help you with home ownership.